Accountants and economists look at profit a little bit differently, and in this video we're going to try to separate out the differences between how accountants look at profit and how economists look at profit, and then we're going to work through a couple examples so that you see that distinction a little bit more clearly. So I'm going to just draw a line right here, and on the left we're going to have accounting profit, and on the right we're going to have economic profit. So accounting profit is total revenue minus what I'm going to call total explicit costs. So minus total explicit cost. And what I mean by explicit costs are these are things that you can put a dollar amount on and that you would find on, like, if you looked at the checkbook of a company, or if you looked at the bank statement of a company. So you can value them in dollars, so a dollar value, and then would find on a bank account, let's say, on a bank account. Now, economic profit is a little bit more precise than that. So economic profit is total revenue minus total explicit cost, just like accounting profit, and then also minus total implicit cost. Implicit cost. So we already know what explicit costs are. These are things that are, have a dollar amount and are written down on a piece of paper somewhere, either in a bank or on a credit card or whatever. But we haven't talked about implicit costs yet. So implicit costs are basically their opportunity costs. They are the common ones are time, and then returns that you could have been earning on invested money. So returns on dollars invested. And what I mean by this is that you could have put your money somewhere else. If you invested a bunch of money in a company and you could have invested it somewhere else, the amount of return, the amount of money that you would have gotten for investing your money somewhere else is the implicit cost of that money. It's called the time value of money. So these are all of our opportunity costs. These are the things that really are what economists worry about all the time. It's what is the next best thing that you could have been doing with your money or your time. So economic profit is going to be less than accounting profit. So I'll put economic profit, EP for economic profit, is going to be less than or equal to accounting profit. And the only time that it will be equal to accounting profit is if you have absolutely no opportunity costs, which in reality I can't really think of a situation where that would be true, but I guess you could kind of come up with something. If you had a company that absolutely didn't use any money and didn't use any of your time whatsoever, then I guess they could be equal. But most of the time, economic profit will be just less than accounting profit. So now we've been kind of talking in abstractions, and so now we're going to get down to actually an example so that you can see this a little bit better. So let's say that a firm earns $100 million in revenue and has these costs laid out below. So it has $30 million in materials to make whatever it sells. It has $50 million that it pays to its employees for labor. And it has $10 million that it pays for rent for the buildings for all of their offices. So the first question is just, what is the firm's accounting profit? And it's pretty simple. It's just 100 million minus 30 minus 50 minus 10. So these are all explicit costs. The company had to write checks to its suppliers for materials. It had to write checks to its employees for their paychecks, for their salaries, and it had to write checks to its landlord for the rent for the buildings that it was occupying. So these all have explicit dollar amounts. They're listed right here. They all have dollar amounts that are written down. And you can imagine seeing any of these on kind of a bank statement for a company. So 100 minus 30 is 70, minus 50 is 20, minus 10 is 10. So this firm earned $10 million in accounting profit, and I'm just going to abbreviate that AP. So now if there was $100 million invested in the firm, and that money could have earned 5% over the past year, what is the firm's economic profit? So we know here that economic profit is going to be 100. So I'll put an EP, you know what, I'll change up colors just to keep it clear. So we'll go over to this purple. So we have economic profit is equal to total revenue, which is the 100, minus all of the explicit costs, so it's going to be the exact same thing as we had for accounting profit, minus the opportunity cost of that money. So let's figure out how much we could have earned on that money in the past year. So we had $100 million, and we could have earned 5%. So we could have earned 0.05% on that. So 100 times 0.05 is 5. So on that $100 million, we could have earned $5 million in interest. But instead, we invested in this company. And so we are going to get the profit from this company, but we have to take into consideration that we could have gotten $5 million somewhere else. So this is going to be minus an additional $5 million. And that's going to give us our economic profit. So I just want to reiterate, this $5 million here, this is the opportunity cost. The opportunity cost of, it often gets called of capital, but that's really of money. It's the where else you could have invested your money and the amount of money you could have earned on it for investing it somewhere else. So that's right here, that's this 5. So this entire part right here was just equal to 10 million, and 10 million minus 5 million is 5 million. So our economic profit would have been $5 million. So we would have earned $5 million more than we could have anywhere else by investing in this business in this situation. So now let's switch over to a completely different situation. Now assume that the firm is completely privately owned and the owner doesn't take a salary. But in the time she spent working for her company, she could have earned $10 million. So she's a CEO of her company, and if she were to go to work for another company, she would get $10 million a year. So what is the firm's economic profit now? So this question doesn't mention anything at all about the opportunity cost of capital, or the opportunity cost of money, so we're not even going to consider that here. Now we know that we have all of the exact same total revenue and the exact same explicit costs. So we are going to have that economic profit. I'll just rewrite this once so that we can kind of reference it right here. Is total revenue minus explicit costs, EC, minus implicit costs, IC. So we don't know what economic profit is, so I'll just leave that there. We know that total revenue is 100. We know that our explicit costs are 30 for materials and 50 for labor and 10 for rent, and then minus our implicit costs. Now our implicit costs here are going to be that $10 million that the owner could have earned working somewhere else. This is the value of her time, the time that she spends working for her company. So minus another $10 million. So we now have 30 plus 50 is 80, plus 10 is 90, and 100 minus 90 minus 10 is equal to 0. So the firm's economic profit now, economic profit is $0. And what this means is that everyone involved in this company, or this company, could do just as well in another business or in another situation. That the opportunity cost of all of the resources used in this firm is exactly equal to the amount of profit that this firm earns. So this firm earns a 0 economic profit. It does not do any better in this industry than it could in another industry. And the owner's time is spent just as well working for her company as it would be spent working for another company, but it's not spent any better, or she doesn't earn any greater return working for her company. So that's all that I want to say about accounting and economic profit. You need to know the difference between the two, and you need to understand what kind of costs are explicit costs and what kind of costs are implicit costs. But I think I've done a pretty good job of covering the big ones, and if you have any further questions, just let me know.